If you earn over $73,000 a year in Canada, the CRA has found a hidden way to take more of your money. It's a charge that appears on your pay stub, but it isn't income tax, and most Canadians have no idea it's even there until it's already been taken. It's a silent increase to your deductions, a payroll hike that quietly chips away at your earnings, especially if you are a high-income earner or self-employed. I see the devastating aftermath of these hidden costs all the time. A new client comes to me, a successful entrepreneur or a seasoned professional, and they can't figure out why their take-home pay seems to be shrinking, even though they've gotten a raise. They think they've done everything right, but they feel like they're running in place. When we look at their pay statement together, I can point directly to the line item that's causing the damage. My goal today is to get to you before that happens, to pull back the curtain on this system so you can understand exactly where your money is going. This isn't about some obscure loophole or a rare audit situation. We deal with these CRA rules every single day, and I can tell you, they are not designed to be simple. They are complex by design. The government isn't going to send you a friendly reminder that your payroll deductions are about to jump. They just take the money, and it's up to you to figure out why. Today, we're going to do just that. We're going to dissect this hidden charge, show you exactly how it's calculated, and most importantly, discuss what it means for your financial future. So, what is this hidden tax? It's officially called the Second Additional Canada Pension Plan Contribution, or CPP2. But let's call it what it feels like, a second layer of pension tax. For decades, the CPP system was relatively straightforward. You and your employer contributed a percentage of your income up to a certain limit, the year's maximum pensionable earnings, or YMPE. Once you hit that ceiling for the year, you stopped paying CPP contributions. For high-income earners, this often meant seeing a welcome bump in their take-home pay in the last few months of the year. That system is now a thing of the past.
Starting in 2024, the government introduced a second tier of contributions. Think of it like this. For years, you were asked to fill one bucket with water. Once it was full, you were done for the day. Now, the government has placed a second, smaller bucket on top of the first one. The moment you finish filling the first bucket, you have to immediately start filling the second. You don't get a break. The contributions just keep on coming, but at a different rate. This is where the video's title comes in. The figure of $73,200 was the ceiling for this new second tier back when it was introduced in 2024. But the CRA, in its relentless way, doesn't let these numbers sit still. They creep up every single year. For 2026, the landscape has shifted again, and the numbers are even higher. The first earnings ceiling, the top of that first bucket, is now $74,600. The second, new ceiling, the top of the second bucket, is now $85,000. This means if you earn anywhere between $74,600 and $85,000, you are subject to this second layer of CPP contributions. It's a mandatory 4% deduction for employees and a staggering 8% for the self-employed on every single dollar you earn within that specific income band. Let's break down the three critical things you need to understand about this new system. First, the mechanics of how it works. Second, the real-world cost to your paycheck. And third, the long-term implications for your retirement, because this isn't just a tax, it's a forced investment, and you need to know if it's a good one. First, let's look at the mechanics. The system is now split into two parts. The first part is the original CPP. For 2026, you and your employer each contribute 5.95% on your income, up to that first ceiling of $74,600. The first $3,500 of your income is exempt, but after that, the 5.95% rate kicks in. This continues until your total contributions for the year hit the maximum of $4,130.45. If you're self-employed, you bear the full burden, paying both the employee and employer portions, which comes to a total of 11.9%, for a maximum of $8,460.90. For many Canadians, that's where the story ends. But for those of you earning more, the second act begins immediately. The moment your income crosses that $74,600 threshold, the new CPP2 contributions start. On the band of income between $74,600 and the new higher ceiling of $85,000, you are hit with an additional contribution rate. You and your employer each pay another 4%. That's a total of 8% disappearing from that portion of your pay. For the self-employed, it's a full 8% that you have to remit yourself. This continues until your income hits $85,000. The maximum additional contribution for an employee is $416, and for a self-employed individual, it's $832 for the year. Now you might be thinking, Daniel, $416 isn't going to break the bank. And you're right, in isolation, it might not seem like a fortune, but that's one of the biggest myths about wealth building, and it's a trap that costs Canadian families a fortune. It's the idea that the small numbers don't matter. They do. Wealth isn't built by ignoring the small deductions. It's built by understanding and optimizing every single one. This is a classic case of death by 1,000 cuts. The CRA relies on you seeing that small number and shrugging it off. But it's not just one small number. It's part of a much larger, ever-increasing burden on Canadian earners. This brings us to the second point, the real-world cost. Let's put this into perspective with a story. Let me tell you about a client. We'll call her Sarah. Sarah is a marketing director at a tech firm in Toronto. She's 48, works incredibly hard, and in 2026, her salary is $90,000. She's a high achiever, and she's focused on paying down her mortgage and maximizing her RRSP and TFSA contributions. She came to me because she felt like her finances were stagnating despite her income growth. When we sat down and looked at her 2026 pay stubs, the impact of CPP2 was crystal clear. First, on her income up to $74,600, she paid the standard CPP contribution. That was $4,230.45 deducted over the first several months of the year. But then, as her income continued, the second charge kicked in. On the portion of her salary from $74,600 up to $85,000, a band of $10,400, she paid an additional 4%. That was another $416 that vanished from her paycheck. Her employer had to match that, meaning her employment cost the company an extra $416 they might have otherwise put towards her bonus or benefits. So for Sarah, her total CPP deduction for the year wasn't just the base amount. It was $4,230.45 plus the extra $416 for a total of $4,646.45. That's nearly $5,000. Now let's compare that to her colleague Mark, who earns $70,000. Mark only pays the base CPP, so his maximum contribution for the year is just under $4,000. Sarah earns $20,000 more than Mark, but her mandatory pension contributions are significantly higher, not just in absolute dollars, but as a percentage of that extra income. The effective CPP rate on that band of income between the two ceilings is a punishing 9.95% for an employee, 5.95% base plus 4% CPP2. That's nearly 10 cents of every dollar in that range, gone before it ever hits your bank account. Now, let's consider another client. Let's call him David. David is a self-employed consultant, also earning $90,000. His situation is even more stark. Because he is his own employer, he has to pay both halves of the contribution. On his income up to $74,600, he pays the full self-employed rate of 11.9%, costing him $8,460.90. Then, on his income between $74,600 and $85,000, he pays the full 8% CPP2 rate, which is another $830. His total mandatory CPP contribution for the year is a staggering $9,292.90. That's more than 10% of his gross income being funneled directly into a government-mandated pension plan. For entrepreneurs and small business owners, this is a direct hit to their cash flow, money that could be reinvested into their business, used to hire an employee, or saved for a rainy day. This isn't something you can put off until next year. The rules are complex, and the cost of inaction is enormous. If you're getting value from this and want to learn more about protecting your Canadian-earned wealth from the constant creep of taxes and deductions, hit that subscribe button. It's free financial education that could save you thousands, and it helps us reach and empower more people just like you. This leads us to the third, and perhaps most critical point. What does this mean for your retirement? The government's justification for this enhanced CPP program is that it will provide a larger, more secure pension for you in your retirement years. And on the surface, that's true. The goal of the CPP enhancement is to increase the maximum CPP retirement pension by more than 50% for those who contribute to it over a full 40-year career. It's designed to replace a larger portion of your pre-retirement income. But here's the question you need to ask yourself. Is this the best use of your money? This is not an optional investment. It is a forced one. You have no say in how this money is invested. It's managed by the CPP Investment Board, a massive institutional fund. They have a strong track record, but you are giving up control. For that $832 that David, our self-employed consultant, is forced to contribute to CPP2, could he have gotten a better return by investing it himself? Could he have put it into his TFSA, where it would grow completely tax-free? Could he have invested it in his own business, where the potential for growth might be exponentially higher? The answer is, it depends. It depends on your risk tolerance, your investment knowledge, and your other financial goals. Let me know in the comments. Have you noticed this extra CPP2 deduction on your pay stub? Was it a surprise to you? I'm curious to hear how many people were aware of this change before watching this video. For many of my clients, especially entrepreneurs, the lack of control is the biggest issue. They are experts at generating returns in their own ventures. A dollar invested in their own company might yield a 20%, 30%, or even 50% return. Being forced to divert thousands of dollars into a government plan that promises a modest, albeit safe, return decades from now can feel incredibly restrictive. It's a trade-off between the safety of a defined benefit pension and the growth potential of a self-directed investment. The government has made that choice for you on this portion of your income. Think of it this way. Not having a clear financial plan is like trying to navigate the 401 in rush hour. Blindfolded, it's not going to end well. You might eventually get to your destination, but it will be a stressful, inefficient, and potentially disastrous journey. Understanding where every single one of your dollars is going, especially the ones being taken off the top, is the first step in taking off the blindfold. This CPP2 contribution is a perfect example. It's a mandatory turn you're being forced to take, and you need to adjust your route accordingly. Now you might be thinking, Daniel, this is all well and good, but what can I actually do about it? It's a mandatory deduction. And you're right, you cannot simply opt out of paying CPP or CPP2. The CRA has entire departments dedicated to ensuring these contributions are made. You need a specialist in your corner too, but what you can do is plan around it. You can make this forced investment a part of a larger, more comprehensive financial strategy. There are 3 key actions you should take. First, you need to forecast your cash flow accurately. If you are an employee, you need to know exactly when you will hit the first and second CPP ceilings. This will tell you when to expect your take-home pay to change during the year. If you are self-employed, you need to be setting aside the correct amount for your tax and CPP remittances. A surprise $9,300 bill at tax time can be devastating if you haven't planned for it. This isn't just about budgeting. It's about strategic financial planning. Second, you must reevaluate your personal investment strategy. Since a larger portion of your retirement savings is now being forcibly allocated to the CPP, you may need to adjust your other investments. Does this allow you to take on more risk and therefore potential reward in your personal portfolio, knowing you have a larger, safer government pension waiting for you? Or, if you're an entrepreneur, does this reinforce the need to maximize the growth of your corporate investments to overcome the drag of these mandatory contributions? These are the conversations I have with successful Canadians every single day. Third, and this is especially crucial for business owners, you need to look at your compensation structure. Is a high salary the most tax-efficient way to pay yourself? Or would a combination of salary and dividends be more advantageous? Paying yourself a dividend from your corporation doesn't attract CPP contributions. This is a complex area of tax planning, and it's not a one-size-fits-all solution. The wrong move can trigger other tax consequences. But for many business owners, there is an optimal blend that can significantly reduce their overall tax and deduction burden. This is the kind of planning we do for our clients every day. If you're feeling overwhelmed by these complexities and want a clear path forward, there's a link in the description where you can book a confidential consultation to discuss your specific situation. Let's look at another case study. A client of mine, let's call him Michael. Michael runs a successful construction company. He's 55, and for years, he paid himself a straight salary of $150,000. Every year, he would max out his CPP contributions early and then have to remit the full self-employed portion at tax time. When he came to me, we did a full analysis of his corporate and personal finances. We determined that by restructuring his compensation, he could achieve significant savings. We lowered his salary to the first CPP ceiling, just enough to ensure he was fully contributing to the base plan for his future benefit. The rest of his income was paid out to him as a dividend. This single move saved him thousands of dollars in CPP2 premiums and gave him more control over his cash flow. That money was then redirected into a corporate-held life insurance policy, creating a tax-free nest egg for his retirement and his estate. This is the power of proactive planning. And stay with me, because at the end of this video, I'm going to share the single biggest mistake people make with their beneficiary designations, a simple error that can accidentally disinherit their loved ones and create a massive tax bill for their estate. You don't want to miss that. So, to recap, this hidden tax, the CPP2, is a reality for any Canadian earning over $74,600 in 2026. It's a second 4% layer of pension contributions on income up to $85,000. For the self-employed, that rate is 8%. It represents a fundamental shift in Canada's retirement system, a move towards larger, mandatory government savings and away from individual control. While it promises a higher pension in the future, it comes at the cost of reduced cash flow and investment freedom today. Your action plan is clear. First, get absolute clarity on your numbers. Calculate your expected CPP and CPP2 contributions for the year so there are no surprises. Second, review your investment strategy in light of this forced saving. And third, if you're a business owner, you must explore different compensation strategies to ensure you are not paying a penny more in taxes or deductions than absolutely necessary. If you have a business partner, a spouse, or a friend who is a high-income earner or runs their own business, please share this video with them. You could be saving them from a massive financial headache and empowering them to take control of their financial future. This is information every successful Canadian needs to have. Now, for that final critical piece of advice. The single biggest mistake I see people make is with their beneficiary designations, particularly on their RRSPs and RRIFs. Many people simply name their estate as the beneficiary. This can be a catastrophic error. When you name your estate, the entire value of your RRSP or RRIF is included on your final tax return and is subject to tax at your marginal rate, which can be over 50%. Then the remaining amount flows into your estate, where it is subject to probate fees. Think of probate fees as a final parting tax from the provincial government, just for the privilege of passing on what you own. In provinces like Ontario or British Columbia, these fees can be substantial. However, if you name a spouse, a child, or another individual directly as the beneficiary on the account itself, the money flows directly to them, completely bypassing your estate. It avoids probate fees entirely, and in the case of a spouse, the funds can be rolled over to their own RRSP or RRIF on a tax-deferred basis, avoiding that massive immediate tax bill. This simple administrative step, updating a form with your financial institution, can save your family tens or even hundreds of thousands of dollars. It ensures your legacy goes to your loved ones, not to the government. I've seen the devastating aftermath of a poorly planned beneficiary designation. I've seen fortunes built over a lifetime get decimated by taxes and fees that were completely avoidable. Don't let that happen to you. Check your beneficiary designations today. It might be the most valuable 5 minutes you ever spend. I get it. This stuff is overwhelming. The tax code is thousands of pages long. But you don't have to be an expert in all of it. You just need a plan and a team to help you execute it. Thank you for your time today. I hope this has been valuable. We'll see you in the next video.